Welcome to our event this afternoon on what is next for Europe's banking system. It's a great pleasure to welcome and host today Valdis Dombrovskis, Vice President of the European Commission, who is now in charge of the financial and banking portfolio after Jonathan Hill's departure from the European Commission. And I'm also glad to welcome Reza Moghadam, who is not an unknown figure in Brussels in his previous position, but who is now the Vice Chairman for Sovereigns and Official Institutions at Morgan Stanley, based in London. So I think the big topic, of course, is Brexit and how Brexit will impact the shape of the financial system, which currently is very much concentrated and located in the city of London for the European Union, and where after Brexit, depending on the future arrangement that will exist, quite a number of obstacles could emerge for trading banking services across the channel. And just to give one number from ongoing work at Bruegel, so if you just take the investment banking that is being provided out of London to the European Union, we come up with an amount that is close to 2,000 billion euros in terms of assets. Could be more. I mean, it's a little bit of a guess, but it's an informed guess. Let's put it this way. And that, of course, is not an insignificant amount of money. It is basically the size of French GDP. And as you can imagine, we should avoid that there's major disruptions on this that could harm the financing of the economy on the European side. Now, whether that is the case or not, I think is a big debate, and certainly one of the topics we will discuss today. So Valdis has agreed today to present his vision also for Europe's banking system, but also to talk about, I think, the more short-term, medium-term regulatory agenda. And so I very much look forward to your comments, your speech, your keynote speech, and then Reza will react, and then I will open it up so that everybody in the room gets a chance to ask a question or make a comment. Valdis, please.
Thank you. So, ladies and gentlemen, first of all, I would like to thank Bruegel for this invitation and for the opportunity to set out my approach to regulating Europe's banking sector. Subdued global growth, Britain's referendum result, and last week's American elections all mean I do so against the backdrop of increased uncertainty. This environment makes the need for predictable, level-headed policy more important than ever. From the macroeconomic perspective, this means sticking to our plan, pursuing responsible fiscal policies, undertaking structural reforms to increase Europe's competitiveness, and support investment and create jobs to reduce inequality. It sharpens our focus on making sure no one is left behind. In the area of financial services, it underscores the need for stability, for the certainty that businesses need to thrive, and for a framework in which safe banking sector can play its full part in building a more prosperous Europe. Banks have a fundamental role to play in our society. We depend on their lending for companies to invest, remain competitive, and sell into the bigger markets, and so that households can plan ahead. In practice, this means the European Commission is focusing on maintaining a regulatory framework that encourages a banking sector that is stable, sustainable, diverse, and integrated. By stable, I mean a banking sector that is governed responsibly and has a capacity to withstand economic shocks without the financing of Europe's economy being jeopardized. By sustainable, I mean banks that are able to earn fair returns on their investments, compete internationally, and therefore maintain and expand lending to the wider economy. By diverse, I mean a sector that is able to respond to the whole range of financing needs, from small loans to family businesses to hedging multinational companies, banks of diverse sizes and with different business models. And by integrated, I mean the sectors that competes freely across a single market, supporting the efficient allocation of capital and diversifying risk. This is particularly important in the euro area for a smooth transmission of monetary policy. But if this is our approach, if these are the objectives of our framework, we then need to be clear on our banking sector's performance and tackle head-on the significant challenges it still faces. Recent reforms have made our banking sector more stable and resilient. Overall, the sector is much better capitalized, as it has been shown by recent stress tests. Banks have raised more than 800 billion euros in capital since the financial crisis. The average capital ratio in 2015 for banks was at 13.2%, 4 percentage points higher than in 2011. Monetary policy has also helped to improve credit growth in Europe. In the euro area, the European Central Bank has provided abundant liquidity, including through long-term refinancing operations. It launched a large asset purchase program and cut interest rates to record low levels. Elsewhere in the EU, central banks are also pursuing accommodative monetary policies. This is having an effect on the demand and supply of lending. Credit growth has been uneven, but overall lending to non-financial companies in the EU has increased by 1.2% so far this year. And total lending by euro area banks grew by 1% in 2015. Banks have eased access to finance to the private sector. The cost of new corporate loans has fallen significantly in a number of countries, such as Portugal, Italy, and Spain. As regards credit, we are starting to move in the right direction. But Europe's weak recovery, low inflation, and low interest rates are putting pressure on banks, particularly those reliant on net interest income. Analysts have forecast returns on equity to fall further over the next 5 years. This outlook weighs on a bank's share prices and decreases their returns on capital. This environment means banks across Europe are updating their business models. At the moment, it is clear that parts of our banking sector do not have the scale or, in some cases, the expertise to make the most of the technological change. Digital payments and other innovations are developing rapidly. European banks will have to seize on digital innovations and work them into their business models. The Commission is working to keep on top of digital transformation across all sectors. We want to foster innovations, give businesses a space to adapt and make most of it. But we need to monitor changes closely to keep our existing rules fit for purpose. Yesterday, the Commission set up a FinTech task force to do just this. It will include experts on financial services regulation, but also specialists in technology, data, and competition policies. Post-crisis challenges are also still being dealt with. In some countries, high levels of non-performing loans and outstanding restructuring needs put narrowing bank profits margins under pressure. We have made great strides forward in setting up a banking union, but the regulatory framework for banks has yet to be fully implemented. A number of gaps need to be filled to mitigate systemic risk and encourage pan-European banking activities. A strong banking sector in Europe is a diverse banking sector. We need small banks servicing local communities and businesses, and larger banks operating and lending right across the single market. So if we are serious about wanting an integrated sector to absorb shocks and facilitate the transmission of monetary policy, we need a clear European framework. In response to these very real challenges, some might be tempted to reverse the reforms we undertook during the crisis, to lower requirements, or give up on following international standards and the single rule book. But this would just create more uncertainty and instability. It would undermine a regulatory architecture that puts banks back on the heart of our economy, trusted and relied upon by businesses and households alike. So my goal is to strengthen confidence and stability in the sector by building on our new regulatory architecture to reduce risks and complete the banking union. At the same time, we need to adjust our framework where necessary to make it more proportionate and growth-friendly. These twin priorities have underpinned our upcoming proposals to revise the Capital Requirements Regulation and Directive. And they will be also our approach to the measures still being discussed internationally, currently not covered by our upcoming proposals. For more resilient banks and to enhance financial stability, we will integrate standards into European legislation recently agreed by the Basel Committee. So we'll integrate those standards which had been recently agreed by the Basel Committee on Banking Supervision and Financial Stability Board. We will make sure Europe fully tackles the risks linked to the global and systemically important banks, and we will propose they hold a minimum total loss absorbing capacity so that they can absorb losses better, and we can be sure that even the most systemically important banks can, if necessary, be resolved. Europe has established a new bank resolution framework only a couple of years ago. This framework remains the right one to resolve ailing banks and limit the impact on financial stability and taxpayers. So we want to maintain this framework and to incorporate the TLAC rule into the existing minimum requirements for own funds and eligible liabilities, or MREL. We expect up to 13 banking groups would have to comply with the TLAC standard in the EU. Where other banks pose similar systemic risk, we expect resolution authorities to deal with this on case-by-case basis under the MREL. We will introduce a binding leverage ratio of 3%. Cheap credit can give rise to excessive leverage building up in the financial system. Banks have learned this lesson from the financial crisis. So to avoid repeating past mistakes, we will add the leverage ratio alongside risk based on funds requirement in the Capital Requirements Regulation. Put simply, this leverage ratio will act as a backstop to banks' internal model-based capital requirements. We remain fully engaged on ongoing Basel Committee discussion on the appropriate leverage ratio for GSIBs and make sure any agreement is applied in a way that works for Europe. We will introduce a net stable funding ratio, or Nsfr. This will require banks to finance their long-term loans with stable sources of funding and strengthen banks' ability to handle periods of market stress better, such as after the UK referendum or during the last Greek crisis. The Nsfr aims to limit over-reliance on the wholesale funding during times of ample market liquidity and encourages better assessment of liquidity risk across the board. We also want to clarify how Pillar 2 capital requirements should be applied by national supervisors and increase transparency by introducing disclosure obligations in this area. Banks operate in global markets. It makes sense to implement international standards to encourage a level playing field and sound regulation internationally. But we will also work to make sure that our regulation works for Europe to prevent unintended interaction with existing rules and support banks' lending capacity to the European economy. With this in mind, the feedback from the call for evidence on financial services has helped shape the upcoming legislative proposals. We will propose to introduce SME supporting factor to all SMEs loans and apply similar measures to infrastructure finance. We will propose bank capital charges for investment in infrastructure projects to be reduced, providing these comply with criteria which lower risk profiles and increase the predictability of cash flows. Where we can, we will reduce the administrative burden linked to some rules in the area of remuneration. And our proposals will strengthen the proportionality of banking prudential regulation and make changes to reduce reporting burdens. We would like to see lighter disclosure requirements for small credit institutions and simplify approaches for trading-related capital requirements. Our revisions to the Capital Requirements Regulation and Directive will aim to help banks support deeper and more liquid capital markets in Europe. So our proposals will include specific adjustments to avoid disproportionate capital requirements for trading book positions, including market-making activities. We will reduce costs for issuing and holding certain high-quality financial instruments, such as covered bonds, high-quality securitization instruments, or derivatives for hedging purposes. And we will make sure we have the right incentives in place for institutions acting as intermediaries for trades cleared by CCPs. Behind our upcoming proposals, the completion of the banking union remains a priority. We need it for a coherent and predictable regulatory framework, but also to support integrated banking markets across the EU. Risk sharing needs to go hand in hand with risk reduction measures we are incorporating into our legislation. Our proposal for a European deposit insurance scheme would reduce the vulnerability of national deposit guarantee schemes to large local shocks and weaken the link between banks and national governments. By mutualizing national deposit guarantee schemes, our proposal would provide stronger cover for all retail depositors in the banking union and ensures that depositor confidence in a bank would not depend on the bank's location. We are now counting on the co-legislators to take this forward. It is good news that Esther de Lange's draft report is now being discussed in the European Parliament. We will continue to work closely with Member States to reduce high levels of non-performing loans. The European Commission is supporting policy responses by Member States through its Structural Reform Support Service established in July last year. We're already seeing keen interest from a number of Member States to work with us in this area. At the same time, we're conducting a review of loan enforcement regimes to get a clearer picture of the impact on banks in terms of delays, costs, and value recovery. In the coming weeks, we will present a proposal for effective arrangements for restructuring viable business debt, giving companies a second chance. Through the European semester process, we have made country-specific recommendations to 6 Member States to address non-performing loans. And we are working with national authorities to find tailor-made solutions in the framework of existing rules on bank resolution and state aid. As part of the midterm review of the Capital Markets Union, the Commission will assess the case for the development of the secondary market for distressed debt. Together, these priorities make up a balanced approach to the banking sector, to strengthen our regulatory framework and support financial stability, but also support strong European banks. Banks that are safe, competitive internationally, and responsible with forward-looking business models. This approach lies behind the banking union's proposals already on the table and proposals that we will shortly make to revise the CRR and CRD legislation. It will also underpin our follow-up to the call for evidence, our proposal on central counterparty recovery and resolution, and the review of European market infrastructure regulation. This is an ambitious approach we want to take forward, working closely with industry, consumer groups, Member States, and the European Parliament. And one I believe can make a real difference to supporting sustainable growth and jobs across the EU. Thank you very much.
Well, thank you very much, Valdis, for this very clear speech. So let me get Reza to react, and then we start the discussion.
Thank you, Guntram. Thank you, Commissioner, for a very clear speech. I thought perhaps I'll do 2 things. Give a little bit of market perspective on the banking system, and then also, before the Commissioner spoke, I wrote down 7 issues for the banking system. I am Persian, and we usually do things in 7, so I wrote down 7. And I think the Commissioner covered most of those, but I thought there would be useful background to assess some of the initiatives that the Commissioner is taking. And before I say those 2 things, I think one point the Commissioner mentioned at the beginning of his speech, I think one has to acknowledge that there has been a lot of progress in the European banking system and the regulatory environment. The Commissioner mentioned capital. I think if you look at median capital, it has almost doubled since the crisis. Tier 1 capital has doubled. If you look at the banks deleveraging, substantial deleveraging has been done, and therefore the liquidity ratios are much better. And there's been progress on funding side. I think, again, the Commissioner touched on some further progress that needs to be made, but there has been progress on the funding side, and in part thanks to what ECB has done. But let me just provide a little bit of market perspective. I think over the last 1 to 3 months, I would say, the market valuation of banks has been volatile but improving. And it has improved a lot over the last few days. What are the reasons for that? I think there are perhaps two. One is the current hope that growth in the US and the rest of the world will pick up, partly because of US stimulus in the pipeline. It may be a hope, but that's what markets are believing right now. And secondly, they also are thinking that the regulatory environment for the banks will be easier. So those help valuation right now. But current valuations still tell you that the banks are perceived to be rather vulnerable. And so valuations are much lower in Europe, for example, compared to the US banks. And if you look at analyst recommendations, while perhaps in Europe they are becoming more neutral on the banking system, in the US they are more positive because of some of the other reasons. But what is perhaps interesting to me is, at the moment, though, there is appetite for investment into the European banks, and therefore there are prospects of raising more capital if needed. But let me explain that a little bit. I mean, first of all, there hasn't been much equity issuance in the European banks for some time. Since the summer, there hasn't been. But certainly within our bank, I hear more analysts encouraging banks to at least look at equity issuance. But here, of course, you need both supply and demand. I think the demand is there, but on the supply side, there is a concern about basically diluting current shareholders. So that's an issue. In terms of debt, also, there is quite a lot of interest. If you look at Tier 1 capital, European banks have issued a lot of Tier 1 capital over the last 3 years, and perhaps some of that is coming to an end. But what is interesting there is the Commission has been responsive to some of the issues that the banking community has been making in terms of comparability of treatment and the legal framework across the countries, and therefore some of the actions you have taken have helped market respond. And the same, there is interest in Tier 2 capital, in part because the returns are high. That's a much simpler instrument for investors. So the interest in terms of debt, Tier 1 and Tier 2, is there, but perhaps we are coming to the end of a period where a lot of capital has been raised. But investor interest is there. Markets are focused on TLAC and MREL going forward. So I think what I would encourage, the kind of approach that the Commission has had in ensuring consistency and a good framework that can be easily absorbed by the markets on Tier 1 and Tier 2 capital, is replicating that as we move forward to TLAC and MREL. Now, just a few points overall, now taking a step back and looking at the European banking system, just a few points, my 7 very quick points in terms of looking at the European banking system. Number 1, I think there is still concern that there are legacy issues. These are crisis legacy issues, and they are twofold. One, the NPLs. There is still concern about the resolution of those, and I'll come back to that. And secondly, about profitability. Now, that is understandable given that the balance sheets have been shrinking, that the interest rate environment has not been supportive of profitability for understandable reasons. Growth has not been supportive in the European environment. And of course, the banks have had to deal with fines as a result of past behavior. Now, all of those makes the legacy of the crisis still with us and unresolved. Secondly, the regulatory environment, the Commission touched a lot on that going forward. The regulatory environment currently is one which is designed for a system that is in steady state. We are not in a steady state. We are still dealing with the legacies of the crisis, and the issue is the regulatory environment supportive enough to deal with some of the regulatory issues that still, for some of the challenges of the banks that still exist, such as the NPLs. Number three, fragmentation. I think a lot of progress has been done on banking union, but we are not seeing the full impact of banking union yet because there is fragmentation. Some fragmentation has improved. For example, thanks to the ECB actions, lending rates across countries have converged very much, but cross-border activity still is not taking place as much as one would need to have full benefits of banking union. Number four, the Commissioner mentioned the bank sovereign loops. Again, progress has been made, particularly in terms of bank effects on sovereigns. I mentioned that the new BRRD does impede the ability to deal with NPLs perhaps, but on the other hand, it protects the sovereign. So that side there's been progress. But progress in terms of sovereigns affecting the banks is still an issue. And if you look at the valuation of banks by country and the risk premium, that is still built in there. And you see as some countries' CDS spread goes up, so does the bank CDS spreads. Number five, the landscape for financial profitability. I think it is good here that SSM is very much focused on bank profitability and business models. But there is still a question in the markets whether the European banks have business models that are sufficiently profitable moving forward. Number six, again, Commission, you mentioned technology. I think that's an incredibly important issue. You mentioned you have formed a task force to look at this. It is a double-edged sword in the sense that it helps reduce costs in many ways. For example, all bankers complain about the burden of regulation, and it could help a lot in terms of verification of accounts and therefore implementation of regulation, and also in the speed of settlement, for example, and reducing the cost. But it is also going to challenge the banks because the competitive environment will change perhaps drastically with new players being easily able to enter markets. So I think this is a huge issue, and I think a very good focus of what the Commissioner mentioned in terms of Commission going forward. Finally, you didn't mention much in your speech, Commissioner, about the Capital Markets Union, but I know you are responsible for that, and I think we have to look forward to another speech on Capital Markets Union. I'm sure it is in the pipeline, but Guntram, you mentioned Brexit. I think Capital Markets Union without London is a huge challenge for Europe going forward, and ideas to rejuvenate that. I know I think I was with a commissioner on a platform in Washington recently, and he talked about it in detailed terms. I think that is now also an essential element against which we have to judge the soundness of European financial system. Thank you.
Great. So perhaps you want to react to some of the points, otherwise I would open up.
Well, maybe I will react to this last point on Capital Markets Union. Indeed, in this speech I was concentrating on banking and our upcoming regulatory agenda. I could deliver another 20-minute speech on Capital Markets Union. But indeed, we had been receiving many questions, especially after the British referendum. So now, with the perspective of the largest capital market actually leaving the EU, what is the perspective for Capital Markets Union? And to this Commission already in September came up with a communication on actually accelerating the work on Capital Markets Union and increasing ambition. So our response is very clear. Capital Markets Union remains a priority. We need to finalize the work on legislative files which are already on table, like securitization, like prospectus, like venture capital, social entrepreneurship, and so on. We're working on insolvency frameworks. I mentioned this second chance, but also on a broader benchmarking of national insolvency frameworks. We finalized a consultation on European personal pensions product, and we'll be assessing the sponsors and coming with some proposal how we move forward with this. We're working on fintech. We already set a task force on green finance. There is going to be a high-level expert group on sustainable finance, and on a number of other areas. So Capital Markets Union is clearly the EU's priority, and with the outcome of the British referendum, we actually see that the case is even stronger, that we develop capital markets across the EU, and that we, to the extent possible, diversify the sources of financing of European economy.
Can I ask you on the diversity of the banking system, because you mentioned that very prominently, that diversity of the banking system is important for its stability, and I think that's sort of a basic insight that, you know, if a shock hits, the more diverse you are, the less that shock becomes immediately systemic. So in that sense, I would agree. Now, at the same time, we have, I think Reza mentioned it very prominently, a profitability issue in the banking, at least parts of the banking system. And by the way, this profitability issue is not something that is extremely recent in terms of sort of an immediate result of quantitative easing of the ECB as being portrayed in some quarters. If you look at the data, some banking systems have been very little profitable for 5, for 10, in some cases for 10 years, basically, right? So how do you square this, really? I mean, the profitability on the one hand, perhaps not enough, and on the other hand, the diversity that you want, and the diversity, of course, means a lot of different players, small players, and so on.
Well, as regards diversity, indeed, as you assessed, the more diverse system is, the better it can withstand different kind of shocks. But I was mentioning one specific direction of work, which is proportionality. That if we want a diverse banking system, we also need to be proportionate in our regulation and not hit, so to say, small players with the same regulation as big players. Because clearly for bigger banks and so it's easier to deal with existing regulations. So we're very much willing to look that our system is also proportionate, well, based to risk, but also adjusting to the size of the banks. And another issue I would highlight on this diversity is that we want to strengthen the bank lending to the SMEs, to the wider economy. And also there we are taking several concrete steps by so to say, facilitating bank lending to SMEs. As regards profitability, indeed, it's one of the challenge banking sector is facing. Of course, if you look at the wider economy, it's double-ended. It's normally a common monetary policy is seen as something which is at the end of the day facilitating the economic growth and beneficial to the wider economy. But of course we need to see that there are certain constraints from the banking sector, and you mentioned previous years, it's probably more like an aftermath of the global financial economical crisis, and some of the legacy issues like non-performing loans are still with us, and we still need to deal with those issues. So it's clear that also the banking sector will need to adapt to this new reality. I was mentioning some studies which actually do not expect any increases of return to equity in coming years. And at the same time, banks are confronted with technological change and also still in a process of implementing of number of regulatory requirements which came up as a response to the crisis. So indeed, it's quite a challenging environment, something which we need to acknowledge.
Okay, so perhaps before I open up, let me ask one last question, and I cannot resist to both of you, which is on the US election. And we've seen that there were some announcements already to change the regulatory framework for banks. I think also there was an issue about treating differently small and big banks in the US. Reza, you mentioned that the bank stocks have actually done quite well in the last few days. So how do you think will that spill over on the European continent, and what should be the right response? And let me really ask that question to both of you. I don't know, perhaps Reza, you want to start, and then.
Sure. I think the situation is still unclear.
Yes.
But I think what I described to you is the market perception. I think, speaking as someone that works for an American bank, the banking sector is not asking for watering down of Dodd-Frank, which is the main regulatory guidance and law that governs our operations. And we have almost fully met all Dodd-Frank requirements already. I think it is true that banks do complain about the burden of regulation, but there is also equally an acknowledgement now by management of all the banks, certainly all the American banks, that the current regulatory environment is necessary, and it is also essential to give credibility to banking operations. I think if there are concerns, I would say it's not exactly about the regulation, but there are about two things. One, about a consistency of regulation across jurisdictions. So I think that's also relevant. Global banks will, international banks would operate in Europe as well as the US, as well as Asia. So consistency of regulation. Now that has improved through the crisis, but while there are discussions at the G20 and at Basel level, if those are implemented differently, it causes complications for operations of banks. And the other, which I think is important, is uncertainty about regulatory environment. If there is uncertainty as where you are going in the next few months or year, that creates problems in terms of banking operations, and I think it's those two aspects rather than the regulation itself. But you are correct, the perception at the moment and the market reaction is to do with impact of not just on growth but also on reduced regulation.
I would say it's still early to draw any conclusions. We need to see what indeed the regulatory agenda of the new administration will be, and then see how to address. We have established a joint EU-US regulatory forum where we can actually deal with that kind of regulatory issues.
Okay, let me open up. There must be some questions or comments or ideas. So, Eric Nielsen, perhaps you start. There is a mic. There's a mic coming. Yeah, thank you.
Eric Nielsen from UniCredit on the research side, so I'm on the public side here. So I have two quick comments and two quick questions, if you don't mind. The first one, I just wanted to emphasize this issue of predictability that you talked about and the business model. And you, Commissioner, correctly said there are plenty of estimates out there of let me put it this way, not returning prospect of better return on equity. At the same time as that's what's needed in a way. So there's a real question for me on the business model, whether tons of chances for the banking system, but it is really, if there's not predictability, it's very difficult to go to shareholders. And this is, if I may put it as an encouragement to policymakers, instead of only talking about the banks needing to raise capital, let's talk about those who need to provide the capital, the pension funds, the insurance companies and others. Tell them why they should buy equity in banks when the performance has been so poor for so long, the worst performing sector, and give them a business model and an environment where you can persuasively say things would be better. So that would be the comments. That's necessary, otherwise it won't work. Then in that prospect, or in that context, the second comment on the SME loans, yes, you're right. I mean, the numbers are looking a little bit better. But remember, at least working for an Italian bank, it's the SME loans which have caused the biggest problem in terms of non-performing loans. It's not the sovereigns. It's not anything else than SMEs. And that's what you try to lend more at. And while I'm a big fan of what the ECB has done, so I don't want this to be misunderstood, I think the ECB is doing a fantastic job in trying to stimulate in a very difficult environment. But when they buy increasing number of non-financial corporates, that increases the number of high-quality corporates, their funding cost relative to the banks, which means that your composition of loans out of the banks are now more towards the more risky ones, because the high quality have a better source, namely via the ECB. So this is okay for a while, but one day it may not be so good because the composition is a little bit tricky. And then quickly, two questions. Diversification of businesses, clearly it would be better if you have a bank that operates in several European or other countries, you have more stability because business cycle move a bit and you have a better diversification and everything else. Still today, if I'm told correctly by my colleagues, we still have at UniCredit restrictions on movement of liquidity between European countries. So we have a surplus of liquidity in Germany and Austria and a small deficit in Italy, but we can't move it freely across to some extent. And the result of that is that the deposit increase we have in Germany and Austria goes into the ECB at minus 0.4, while we have to borrow, admittedly now at very low rates, to feed the SME loans in Italy. So one day we hope to get to a stage where what we want, a diversified bank, also management would have the right to move the liquidity freely around inside the Eurozone or EU actually. So that is there hope for that? That was my first question. And the second question, and then I'm done, is the one thing we didn't hear at all was the issue of consolidation of banks. I thought we have agreed that there are too many banks, too much banking in Europe, we need consolidation. But when I look around the banking system, I struggle to find very many banks where I would say, if you put those two or three together, you get a better unit than them. So the result of if we really want consolidation, that's a question. Is there any way around the business of closing down banks? And is that feasible? Thanks.
Mm-hmm. Perhaps we collect a few questions, if you don't mind. Are there further questions? Did you have a question, Sebastian? Or?
Yeah, a couple of questions linked to the first 2 points for both speakers, of course, were raised by Mr. Mogadam. One on legacy issues and the regulatory environment. I mean, the legacy issues, I see this as let's say, conjunctural problem. Why there is a structural problem, this is linked to what the colleague from UniCredit said. That's to say that you have still, although it has been increasing, attraction and capital for banks and recently, but you have still a big difference between cost of equity and return on equity. And this couples with the low profitability, which seems to be a structural issue. So we need a change in business models, as also has been said, because of technological innovation, etc., etc. What are the prospects for these reasonable prospects outside of this conjunctural moment? That's to say, do we need mergers, as people say, changes business model? Is that, in your view, going to be a support from, from Europe, from member states, how to realize that? Because you have, of course, a lot of, over-branching and employing redundancies. No? So this is, I think, an issue that will have to be faced sooner or later. This is also linked to the stability of the regulatory environment. I very much agree with you that, of course, a further issue of perceived stability, at least in the market, is regulation continuously moving. It's no fault of anybody. I concur to shaping the regulation here in Brussels, so therefore it was needed. But certainly this does not help. Continuously changing regulation that, as you said, should be more for the steady state than for this moment. So how to do it? On one side, we have to do it. On the other side, we should have this more for the steady state. Transition helps. This is the question. That's to say, adequate transition, counting also that the market's front-loaded. The future steady state regulations. Thank you very much.
Thank you. There is a question here. There's a question there.
Thank you. Simon Ainsworth, Moody's. I've got a pair of points, I think both of which were alluded to by the speakers. One of which is around kind of TLAC and MREL, and clearly that's one of the big issues facing banks going forward. But it's also one of the areas where in the banking union we've seen a divergence of approach, with Germany going down one route, France another route, Italy a third, and the UK already had a fourth. Can we expect kind of the package coming forward or future proposals after the package to kind of drive some greater harmonisation of approach in terms of how subordination will be achieved? And secondly, the Commissioner also mentioned that there are various initiatives going on around the work with the Member States on dealing with non-performing loans. Clearly, we've seen one of the impacts of the BRRD has been to hamper the ability of states to bail out and to provide support to deal with that, and particularly you've seen that in Italy. Do we expect these initiatives that are now coming forward from the Commission to actually help unblock that problem?
Thank you. Are there further questions, comments, remarks? The gentleman here, yes.
Good evening. I am Mr. Navas, the CEO of Navas Cursi, a Spanish law firm established in Brussels and known in my country. Well, my question is about a social aspect that is happening in all Europe. That is, I call the new poor European. Here's the question. The global financial crisis of 2008 brought to light the complexities and misrepresentation of many structured products. The failure of these investments could be blamed on the structure of the securities, where the pooled securities, which were split into different tranches. Under the Spanish law, for example, under the Spanish law, and also in similar countries like this one, Belgium, Germany, France, or Netherlands, it's possible the securitization of home mortgages implies that the entity that granted the loan is not anymore the creditor of the mortgage, even though it retains legal ownership of the loan and continues to maintain unless otherwise agreed that its administration. Moreover, there is no need to register the change of ownership, what makes it impossible to the debtor to find out who actually is the creditor of this mortgage. In view of the above, and regarding this fact extends to most European members, as I said before, being nowadays the legal framework in this area so uneven and creating defenseless and abusive legal situations for customers, I formally asked to the Commission the following question, making before the comment that you know that there are examples like in Germany, Deutsche Bank or American funds that they are taking out these titles. And the question is, what does think the Vice President if, under his opinion, is compatible with the Directive of 93/13 and the European Union regulations, the fact that financial institutions do notify the mortgage debtor about this assignment of receivable, which prevent to the customer the exercise that has a preference right of a third that is buying his debt for a less amount.
Okay.
It is more worthy and legal the fact that the debtor could, for a less price, purchase his own debt and stay with less debt before a third party does it. How can the European Commission adopt decisions to prevent these legally appearing abuses and to solve the economic context that the European Union lives now? Is there any?
Can you come to an end of the question, please?
I mean, if there is any initiative from the European Commission to watch carefully if there is any abuse on these on these operations, and initiate. And also, the last question is if the Commission is starting any conversation with consumers associations, with investment associations, and try to find out how to solve the problem of the new ports that is a sad reality in Europe. In our country, there are two courts that sent to the Luxembourg court the question of if it is legal.
Thank you very much. Thank you very much. Any last question from the audience, or otherwise let me turn back to my two speakers. And there's one more. Sorry, one more, and then if you don't. Okay. Then.
Thank you very much, Dr. Wolff. My name is Jutaro Kaneko, Japan Center for International Finance. I'd like to ask your opinions on, in the context of Basel III finalization, the impact of standardized approach for operational risk on European banks. Given that the consultation paper of the Basel Committee includes the new model which reflect loss experience for the formula, the new approach could have significant influence to increase the capital charge on European banks, including Deutsche Bank, which could suffer from a significant amount of fine by the U.S. authority. Thank you very much.
Okay, thank you. So perhaps I give the floor first to you.
Okay, thank you. So probably concentrate on those regulatory questions, leaving the bank business model
to the bankers.
Questions to the bankers, because indeed it's our duty to come up with a predictable and proportionate regulation, but we cannot, of course, decide business models for banks. So on some of the questions which were raised. First, on bank profitability in general and on SME loans. And you mentioned also this issue of lots of defaults on SME loans. There I would emphasize that, of course, it's all linked also to the broader EU economic perspective. So if we revive economic growth, if we strengthen the recovery, of course, it has positive implications both for bank sector profitability Also, it means better performance and by the way, so more demand for SME loans. So it's something which will not be able to solve only looking at the bank sector, but we need to look at the EU's economy. So that's actually where I started my speech with EU's economic policy priorities. So tomorrow we are adopting the new what we call autumn economic package. We are presenting the new annual growth survey, setting the economic policy priorities, but basically the direction of these priorities in facilitating investment, in structural reforms to modernize our economies, in responsible fiscal policy. So the main elements of our economic policy priorities remain valid. And then we need to see also the banking sector as part of this wider economic recovery. Then on SME loans, so what we are practically doing, we are expanding the use of SME supporting factor to also give more incentives for the banks to actually lend to the wider economy. As regards diversification, and you put it in a context of cross-border banking activities, indeed, it's one of the aims of the banking union, and proposals we are putting in this context is exactly to reduce cross-border barriers and to ensure more cross-border financial activity. Say, for example, if you look at the retail sector, only 3% of the people are using cross-border financial services. So indeed, there is a broad potential for opening up. We know there are regulatory barriers. There are also regulatory practices in different member states which may prevent movement of liquidity, and indeed this is one of the issues we are looking at. Of course, it's never easy question because it often for multinational banks touches up to the question of relations between home and host authorities, and we know how sensitive this question is. Well, as the question you raised on consolidation of the banking sector, it's not something we are explicitly putting as an aim. It may be the banking sector response to certain economic realities. Our regulatory aim is, of course, to ensure that banks are well capitalized with sufficient liquidities, with ability to lend to the economy. So this doesn't really prejudge the size or number of the banks which should be in the economy. Then to come back to the same question of continuously changing legislation. Well, there are certain things which we are now finalizing in a context of our reactions to the crisis. There are certain things we're implementing now in a context of international agreements, of work of Basel, of Financial Stability Board. But I agree that at a certain stage we should arrive at some kind of steady state and to ensure that there is a more stability in our regulation after this very major overhaul which we had to do after the financial crisis. And I would leave those questions which you asked for overbranching and mergers and so once again to the bankers.
Thank you, sir.
And this question of transition and front loading. This indeed is something which we are seeing. That's why we're so much emphasizing that globally, for example, in Basel, we need to reach an agreement. We need to reach a balanced agreement. And it's clear that we cannot just deviate or try to solve some problems through long transition periods, because markets will anyway front load those requirements or use those requirements while assessing the bank sector performance. So it's very clear issue. Then on this question which was asked on TILAC MREL and creditor hierarchy, new creditors class, indeed it will be part of our proposals also to come up with a harmonized new creditors, so to say, class which would meet TILAC and MREL requirements, and will be coming with the proposals on this creditor hierarchy. So indeed, this will be it's part of our work. Then you asked on this question of BRD versus state support. Well, this is a a controversial issue, but BRRD was introduced exactly to ensure that taxpayers are not the first ones to pay for a banking sector mistakes. That was a main idea. That was the principle of bail-in was introduced. So to be very clear, European Commission thinks we need to work within our existing and recently set legislative framework. As I was saying also during my speech, that there are some voices for watering down this framework. We don't think it will be the right path, but we also see that there are ways to address the issues, including non-performing issues within our existing legislative framework. And there are also certain avenues which are outlined in the very same BRD legislation how it can be done. Then on this Spanish question, I would say this was a specific question. Well, if there was a reference to ongoing court cases, it's something we cannot comment right now. We need to await for the outcome of those courts. But to outline this broader securitization issue, we already have a securitization proposal on table dealing with simple, transparent, and standardized securitization, and among other things, in ensuring that banks can securitize their products, including mortgage loans you had been asking, and sell them to the capital markets. That's how banking sectors had been working in a number of places. Like in US, it's a very common model. Why EU banks have a large balance sheet? Exactly, this is one of the reasons, that they keep bulk of the loans they issue on their balance sheets. Whereas in US, it's sold either to capital markets or to the special entity, Freddie Mac, and banks are actually not holding all the loans issued on their balance sheets. Of course, it raises a number of regulatory and legislative questions which then need to be dealt with. But that's the basic idea also behind our securitization proposal. Mm-hmm. And then final question was on Basel III, on completion of the Basel III, on standardized approaches versus bank internal models, capital requirements. Well, our position has not changed on this. First, we are emphasizing that we need to follow up what has been agreed in a Basel itself, that completion of the Basel III, and that's why it's called completion of the Basel III, should not lead to the significant overall increases in the capital requirements. It's one thing. And second, that it should maintain the risk sensitivity of the capital requirements, meaning that banks which pursue less risky business models have less capital charges, and vice versa. Those which are having more risky business models have more capital charges. And this approach has been endorsed by EU finance ministers in July ECOFIN, and once again we discussed it in ECOFIN in September. And this is the approach with which we are addressing this issue in the Basel Committee. Thank you.
I'll be very brief. One, I think the Commissioner has been quite comprehensive. And two, I know the Commissioner has to go, but maybe just two issues which, in terms of both consolidation and cross-border activity, that would, I think, help a lot in the European context. Those is one, resolving the legacy issue and the NPLs. Complex issue, various ideas have been put forward. It would help a lot if there is a cross-border approach to this rather than country by country. Very difficult to do in the European context, but if it is to be country by country, it requires willingness of the banks and the authorities. It requires adequate capital buffers, and it requires a supporting legal framework along the lines that the Commissioner has been advocating as part of the Capital Markets Union. So you need all of that. The other issue, which I think would help in terms of both the business models and cross-border activity and consolidation, is the reliance of European banks on sovereigns in terms of the magnitude of sovereign bonds that they have on their balance sheet. Again, that issue needs to be addressed. There are a number of ideas on the table. I know both Bruegel has written on this, academics have written on it, the Commission is working on it, but you need to have a solution to that. Consolidating or purchasing, mergers and acquisitions of banks which have large NPLs and large portfolios of sovereign bonds is very difficult to do.
Indeed. Okay, let me thank both of you, Vice President and Reza, very much for this thoughtful exchange. Thank you.